Well, guys, it's just been another brutal week on Wall Street. I'm Rob Luna. This is Wealth Talk. We're going to pick up what we talked about last week. We started the market starting to decline last week, and I told anybody who wanted to get in the market last week, if you were getting in long term, that's okay, but you needed to be prepared for about a 10 to 12% pullback. I'm going to tell you what's going on right now, what I'm looking at, and what you should do if you're invested or thinking about putting some money into the market right now. So, when we were talking last week, I was talking about the potential for this market to decline about 10 to 11%. And so, where did I come up with that? Well, right now, everything is moving on momentum, everything is moving on technicals because there's a big disconnection of what's going on with the 10-year bond right now, what's going on with the economy, and where the market's going. So, remember, the stock market is forward looking. So right now, what we're seeing is interest rates going up. We're seeing, inflation starting to pick up quite a bit. We're starting to hear good news in terms of Lyft just reported their largest increase in weekly rides since the pandemic started. We're hearing now from President Biden that by the end of next month, more than likely, the vast majority of Americans who want to get a vaccine are going to be able to do that. And we know, because I've been talking about this from the beginning of the year, the two biggest issues that were facing the market were obviously the pandemic and also the 10-year treasury or the risk-free rate. And those are two things right now that we're starting to see play out. Well, the stock market, again, as a leading indicator, has been rallying, especially the big growth names of the NASDAQ. And so in my view, even when you look at obviously the cruise ship names, the airline names, that have skyrocketed, a lot of this reopening is starting to be priced into the market. And maybe, just maybe, we got a little bit too far, too fast, and we got out over our skis. So the 10-year bond is probably the biggest issue, just like we talked about last week. Now, when you think about it in perspective, over a long period of time, we pushed over 1.5% Thursday. Is that a big challenge for stocks long run? Well, if you look back to 2018, for example, when we started to push up over 3.5%, that's when we really started to see some challenge because that yield starts becoming competition for other asset classes like stocks and bonds. So in general, 1.5% to 2.25 long term is not going to be a challenge for the market. But the velocity and speed in which we see this yield sweep up to over 1.5% is spooking a lot of investors. And if you have some profits in this market, why not take some off of the table short run? And so that's what we're starting to see right now. Again, let's remember, we always have to separate trading from investing. So if you're a long-term investor, 10, 12, 13% pullbacks in the stock market on average happen about every 10 to 11 months. So this is just a normal process. And we talk for you long-term investors that you need these pullbacks to make sure that the underlying economy, well, in terms of how that's reflected in the stock market, is healthy. We're not getting too far ahead of ourselves. We don't obviously want to go down too bad. And so the market right here at this point is very technical driven. So when you look at the charts, I'm going to put up two charts of the NASDAQ and the S&P. And I told people last week, be prepared for that downdraft because we're getting ready to test that 50-day moving average. Now, both of the averages have broke below the 50-day. The next natural level of support is that secondary line, that long-term trend of the 200-day moving average. Again, these are no guarantees, but it's sufficient to say that because we broke through, because there's still a decent amount of uncertainty out there, there's a very good chance that we pull back and test that 200-day. Now that's just about 6 to 7% from here. So in terms of entry points, myself personally, I don't really like buying below support and above the next level of support. So me, what I'd rather see technically for the way I enter positions is either one of two things. We go back above that 50-day, and if you're looking at a bar chart like we're showing you, you close above that and start to rally from there. That would mean we broke support, went back above it, and now we're starting to rally again. That happens a lot of times. Or what I'd rather do is wait until we go back down to that 200-day moving average, about another 6%. So when I talked about 10 to 11%, we've already lost about 3 to 4. So now there's only about 6% to go. I'd be a little bit patient and wait for the indexes to get there. Now that's the indexes, but you can use the same strategy if you're looking at individual stocks. So if you overlay individual stocks with these two moving averages, you're going to see the same thing. Some of the technology stocks, some really good long-term companies, names we talked about like PayPal, have gotten beaten up more than the market because those names rallied a lot faster than the market. So if you're using these types of charts, maybe individual stock names start to find that support first. That's traditionally what happens, and then they begin to rally from there. So long term, what am I thinking? Well, we just talked about short term. I think we could see some choppiness. It makes sense. We could test the 200-day moving average. So there's still some volatility to come from the market. Long term, I do like what we're hearing out of the economy. I like the fact that we're going to be reopening. If you look at Texas today, and other states are starting to follow suit. They're actually lifting bans in terms of occupancy in restaurants. There's actually no mask mandate any longer. So the economy in Texas, places like Florida, is really starting to get back to normal and is going to be in full swing. This is exactly what we were worried about would not be happening, and that would be extended to fourth quarter and first quarter of next year. So with this latest Johnson & Johnson vaccine being added to the list, a lot more people getting vaccinated a lot quicker, these are all positive things. The business is going to get back to normal. We also have another economic stimulus package that's going to be getting passed. We already talked about money supply increasing and the velocity getting back into the hands of consumers. Unemployment is going to be extended, so those checks are going to be coming at least until August. These are positive things. Who knows? We could even see an infrastructure spending bill. So all these things are very positive, but let's remember the stock market has run already. We're not cheap by any means. We're a little bit on the expensive side historically, but with interest rates staying below 2 and 2.5%, I think things can stabilize and rally. And I do think longer term, because it always happens, these corrections are going to be an opportunity for long-term investors to get your shopping list ready, look at some of those names that you might have missed out on. And when you're seeing these pullbacks, and some of them very dramatic, 20, 30% in the tech names, this might be a good time to add to those. And remember, we always talk about that balanced approach where we have the good, high quality, dividend paying stocks that have actually held up relatively well during this, that have helped stabilize that for us. So what are some of maybe my other concerns that I have? We talked about COVID. We also talked obviously about the tenure. Those are two of the biggest things. But what I'm also a little bit concerned about with the current administration is that we start to see a rise in tax rates. We're talking about over 40% on capital gains, corporate tax rates increasing. We're now hearing about a wealth tax that's going to be set in place. Those things are very, very negative for the economy. Taxes going up at a time where we're just trying to come out of one of the largest crises in American history does not make a lot of sense. And I'm very hopeful that even though we now have a majority in the House and Senate on the Democratic side, that there's enough reasonable people who are going to be able to put the brakes on that deal and not pass a tax increase at a point in time where we're trying to stabilize, and not just rely on the government to print money and give checks to the consumer to spur the economy, but actually let the free market work. Let businesses get back to 100% capacity. Let people get out again, buying things, shopping, traveling. Those are the things long term that are going to sustain this economy. Let's remember, the people that have been hurt the most during this pandemic is the small business owner. The small business owner, though, guys, provides the vast majority of jobs for our economy. And we need to support that small business owner. We need to create and think about more creative stimulus to how do we get people back to work? How do we incentivize people to reopen versus thinking about how do we continue to give more unemployment checks and actually make it, in some cases, more attractive for people to sit home on the couch than get to work. That's a big concern of mine. Also, let's hope that we don't start to have increased regulation. We saw under the previous administration a rollback of some regulation, really no new regulation added. Regulation, guys, is also an additional tax, because when you put more restrictions and more regulations on business, They have to spend more money on things like compliance, legal, putting together things that are not stimulative to the economy, does not allow you to hire more people. It just burdens down your balance sheet with bureaucratic nonsense. So let's hope that's not an issue. Those are two things that I think you're going to hear people starting to talk about more, but let's hope that those things stay away until we can get our legs back under us and start seeing this economy going forward. So in short, it's a continuation of what I talked about last week. Still easily could see another 6 to 7% down to that 200-day moving average. Be prepared for that. But if you're an individual stock picker and there's companies that you like that maybe you missed out on the big run up, this might be a time to dip your toe in. And by all means, let's just say you've got $10,000 to invest. It might be part of where you say, hey, I'll wait some of this to go back to the 200-day. Maybe I'll wait and put some of this if we break back above the 50-day. Maybe I'll take a quarter of it and put it in a couple stocks that maybe are back down at the 200-day now and finding some support. It's not all or none. It's about methodical. It's about having a strategy, and it's about not grasping at straws. And so that's why, guys, I wanted to show you today some of the tools that I use in terms of technical analysis and moving averages to where you don't have to guess at things. Obviously, everything is a risk. Investing in general is a risk, but you want to take calculated risk. You want to put yourself in a position when you're making choices that you have data behind you that's supporting you. And this is something I've been doing for 22 years that's worked out really well for me in terms of my additional buys and my additional sells, is when you're in no man's land like we've seen on the charts there, it's a little bit difficult to do that. So look at support, look at moving averages, look at technical analysis to add to your toolbox to support the qualitative analysis that you do in terms of finding companies that have a great value proposition, are executing on their mission to clients, as well as the quantitative data in terms of valuations, PE ratios, dividend discount models, all those things that you use. When you combine the fundamental analysis with the technical analysis, in my experience, that's when you become the best trader, because there's going to be times like this where there's a lot of noise, very momentum and headline driven, where we're going to see a disconnect on both sides from the fundamentals. And when you have that technical approach, you can look at the charts. It allows you to calm down and make more methodical, higher probability trades and investments in your portfolio. So that's it for this week. Listen, if you haven't subscribed to my channel, please do so. I do this every week to give actionable advice to investors like you. Please share the channel with people who you think can benefit from this. I really want to be able to educate people to make smarter, more informed investment decisions, because at the end of the day, the reason you're investing is not to beat the S&P, is not to beat the NASDAQ or anything like that. It's to put your money in a position to where it grows, to eventually it's a nest egg that generates enough passive income to support your lifestyle. And that's what financial freedom's about. So thanks so much. This is Rob Luna this week for Wealth Talk. Have a great weekend. We'll see you next week.